What if I invested $1 million in the stock market today? How much income would I receive from dividends if I invested $1 million? This is a question that a subscriber recently asked me. This question may actually seem pretty easy at face value, but it actually becomes quite complex. So I wanted to take the opportunity today in today's video to answer this subscriber question, to talk about this scenario about someone potentially investing $1 million and what they could expect from a dividend standpoint, from a cash flow standpoint, because I personally invest for dividends. Capital appreciation is nice and my portfolio has grown in value over time, but the reason that I really invest is for that dividend income that comes through that I can use to pay the bills. And the reason many people want to invest in dividends is so that they can either partially or fully pay for their living expenses from dividends. And so $1 million, it's a nice big number, nice round number. Let's dive into it. Let's see what that can get for us. Let's see what that can produce in dividend income. So let's jump right into it today. If you've been following me for a while, you know that I own 38 stocks, all dividend-paying stocks. And if you take the dividend income that I receive and divide by the market value of my portfolio, my current yield, the dividend yield of my portfolio right now, the current yield is 3.64%. So I think this is a good starting place. Personally, I tend to mix my stocks up. I own a bunch of high-yielding stocks. I own some lower stocks that grow the dividends quicker, and I own some in between. So I have stocks that pay all different kinds of yields. I own them for different reasons. I like to diversify. And in fact, I'll link in the description below to a video that I just produced highlighting my top 10 stocks, the top 10 stocks in my portfolio that I value, my top 10 favorite stocks of all time. You'll see I like to mix stocks. And so overall, my yield, my current yield is a 3.64%. Another assumption here. I'm just going to assume for these models that I'm going to share today that the companies that I own, on average, can grow the dividend 5% per year over time in perpetuity. I actually think 5% might be a little conservative. I think it may be closer to 7%, but the reason I use 5% is there is inflation out there, and so I subtract out 2% to kind of make it a little bit more fair in the face of inflation, and quite frankly, when we get to another scenario below, just to make it a little bit more conservative to counter an assumption that comes up in scenario 2. Anyways, there are really two scenarios. And so when subscribers ask these kind of questions to me, Ian, if I just take this lump sum, I invest it, how much am I going to get? It really is a nuanced question because my question back becomes, hey, in this hypothetical scenario, does one intend on retiring tomorrow? Or does one have some time on their side? Can they delay retirement a bit? And so I'm going to share two scenarios today. The first one is really for someone hypothetically that invests $1 million and retires tomorrow. The second one is for someone that can buy some time. Let's start out with scenario one. I'm just going to spend the dividends right away. I'm going to retire right away. So year zero, this is kind of the starting point right now. The amount invested, the principal, is $1 million. Again, the current yield on this, the starting yield, is 3.64. The reason I came up with that, again, is that's what I'm achieving on my current portfolio right now when I take all of the dividend income that I receive on an annual basis and I divide by my current market value of my entire portfolio. My current dividend yield is 3.64, so I think that's a good starting point. In year zero, like off the bat, basically, the dividend income is $36,400. The way I come up with that is I take $1 million, I multiply by 3.64, $36,400. Now, an important assumption here. I am assuming, just for the sake of modeling, for the sake of simplicity, to make this easier to convey these concepts here on YouTube, I am assuming no capital appreciation. So the principal invested, the capital, it doesn't grow over time. I'm modeling out 10 years here. You'll see it's 1 million, 1 million, 1 million. Doesn't grow. Now, in reality, even if one invests for dividends, the type of dividend companies that I invest in, they tend to do really well over time. They tend to raise their dividends, and the companies are expanding because these companies are doing well and they're expanding, the share price tends to go up. So quite frankly, this model downplays the complete value of dividend investing. Then again, the question being asked is all about cash flow. It's all about how much money would one hypothetically have to live off of. And so the key point here, if someone is investing to live off of their investment, it's a huge, huge golden rule to me to never cut into the principal, never sell the principal. And so again, the principal doesn't really matter. So that's why I just keep it at that constant 1 million, keep things simple. However, in reality, the principal will grow over time, over very long periods of time, especially from my personal experience at least, and just an added benefit of dividend investing. Now, what's interesting here, the person who wants to retire tomorrow, as long as they are smart enough, hypothetically, not to cut into the principal, what they can experience in year one is $36,400, and this will grow over time because, again, the assumption 5% per year. So if I take 3.64 and I multiply it, 3.64%, I multiply it by 1.05 to represent the 5% growth rate in year one. After 1 year of doing this dividend growth investing, the dividend yield becomes 3.82%. It's 5% higher. It increases by 5%. And so another way of looking at this is I could apply this to the annual dividend income column as well. If I take the 36,400, I multiply by 1.05 to represent 5% increase. After 1 year, the dividend income becomes 38,220. If I take 38,220, I divide by my 1 million, my current yield or my dividend yield in year two will be a 3.82%. Anyways, the key point here is that after just 1 year of dividend investing, I get a 5% raise for doing nothing. In fact, all I was smart enough to do here was, Ian, don't cut into the principal. Don't sell the principal. Take your dividends, spend them, live your life, but don't cut into the principal. As long as I do that, because these companies that I invest in typically raise their dividends over time, in year two alone, I'm up. I'm getting $38,000 in cash flow. That's after 1 year. After 2 years, $40,131. After 5 years of dividend investing, $46,457. After 10 years of dividend investing, $59,292. So the beauty here is just in 10 years' time, just because these companies, on average, I expect them to increase their dividends 5% every year, compounded over time, the dividend income, my annual income, increases by 63% over a 10-year period. So when one asks me, hey, Ian, I'm going to invest $1 million, what could I expect to live off of? It's a nuanced question because even in scenario one, the answer is, well, in year one, if it were me in this hypothetical situation, I would be receiving $36,400. However, after 5 years, I would be receiving $46,457. And after 10 years, I would be receiving $59,292. So after 10 years, again, my income is up 63%. This is really exciting to me, really exciting, because the fact of the matter here is even without reinvesting dividends, we'll get into that in a minute, as long as I don't cut into my principal, there's some built-in gains in there over time. I can spend all of my dividends each year, after taxes that is, and certainly this doesn't take taxes into account. Everyone's tax situation is different. People watching my channel are from all over the world. So as you do your own homework, your own modeling, obviously you want to factor in taxes. But pre-tax income, for me, it's raising over time. It's increasing over time in this scenario, even if I don't reinvest dividends. And that is what is so exciting to me about dividend growth investing. And you may be wondering, Ian, what kind of stocks do this? Well, one example is this company, 3M, the makers of this Post-it whiteboard here. I will link in the description below to a video I did all about 3M. This is my number 10 favorite stock of all time. It's in my top 10. Again, I'm going to link in the description below to my top 10. Also worth noting, sign up for my email list. I'll link in the description below on how you can do that. Anyone who signs up in a few days from now, I will shoot over this, I will send over this analysis to everyone. So I have an Excel file. I'm just going to email it out to everyone on my list. So you have this Excel file. You can kind of play around with it at home. You can add different variables into it and change the values, change the growth rates, the amounts to fit your own needs, just to have some fun with that. Anyways, that's scenario one. So the key takeaway again is, boy, though, I am really big on this. For me, at least, my philosophy, don't cut into that principal. It's kind of the principal, the amount invested, that's what's generating the cash flow. It's okay to spend the cash flow, but for me, tapping into principal, unless it's an emergency, is always on the do not do list. So scenario two, here's where the question gets nuanced, because a lot of people are thinking, hey, I got $1 million to invest. And it doesn't have to be $1 million. $1 million is just the placeholder here. Again, in the Excel spreadsheet, if you're on my email list, you'll get it. Again, in the description, I'll share how to get on that email list. It could be anything, and in my Excel spreadsheet, you can change the amount to 500,000, 100,000, whatever it is. But the fact of the matter is, a lot of people may have a lump sum to get started, but they don't need to retire tomorrow. They can delay it. And so scenario two, I take a different approach. I'm saying in this scenario, hey, I'm going to invest this hypothetical $1 million right now. However, I can reinvest all of my dividends and I can delay my retirement for 10 years. So I don't need to retire tomorrow. I don't need to experience scenario one. I don't need to spend these dividends. I can reinvest them in more shares of stock because I'm going to retire 10 years from now. So let's take a look at this. Year zero, when I'm just starting out, basically 1 million invested, the dividend income, 3.64% current yield. Again, I take the current yield that I personally experience right now in my portfolio. Good benchmark, 36,400. That is the hypothetical income just off the bat per year when I'm starting. However, after 1 year, what happens is I have generated a bunch of dividends. I have generated 36,400. And instead of spending these dividends, again, I'm delaying my retirement in this scenario. What I'm going to do with my 36,400 is I'm going to take it and I'm going to buy more stock. I'm going to reinvest it. I'm literally going to buy, in the same percentage allocation, all of the stocks, the 38 in my portfolio that comprise this 3.64 dividend yield. And by doing that, after 1 year, my principal invested becomes 1,036,400. It's literally the 1 million plus the dividends. So if you want to compute this column going down, it's literally just this one plus this one. If I get to this year, it's this one plus this becomes the next one, and just so on and so forth. Now, I will tell you something. There's one assumption in this model, and the assumption is that the cost of my stocks over time are not going up. But in reality, we know over time, over long periods of time, stocks tend to appreciate. They tend to go up over time. In fact, I think the long-term typical return of the S&P 500 per year is about 11% or so. And so we know over long periods of time, stocks tend to appreciate. But in this model, for sake of simplicity, I'm just assuming no capital appreciation. I'm assuming the stocks don't go anywhere. And so as dividends increase, starting yield just continues to increase over time. And so the reason I did that assumption is to keep this thing easy to comprehend for the ease of modeling on YouTube. And the way I counter, so basically this may make the returns look a little better than they are, but the way I softened the returns, the way I made up for that is here. I'm only assuming 5% in dividend growth. It probably should be more like 7%. And so I have kind of two levers in this model, and because I know this lever is overstating potentially the value of the reinvested dividends, I am tapering it a little bit by showing slower dividend growth. Anyways, and again, the reason for that is if the equity is going up over time, as I receive dividends, what happens is when I reinvest them, I'm reinvesting them as different tranches, and the starting yields, the dividend yields on that reinvested money, it actually is lower than the yield on cost of the prior lots. So it gets kind of technical in there, and again, just trying to keep things simplistic, but I think this overall conveys the picture. So, moving on, after 2 years, I have a $1,076,011 invested. The dividend yield, by the way, it's the same as the first model. Each year it's just growing by 5%. And it's these nice numbers similar to this one. Again, because of what I just said, because I'm just reinvesting and I'm assuming the stock prices go nowhere. So what this really means is my dividends start accelerating faster than in scenario 1. So in scenario 1, you can see first few years 36,000, 38, 40, here 36, 39, 43. Not a huge amount of change, but already, even in the early years, the value of reinvesting those dividends, it's starting to separate these two models. But when you get to year 5, the value is even bigger. In this model, I'm yielding 56,582, whereas here I'm yielding 46,457. So I'm starting to see a real discrepancy. 10 years, it gets even more. It gets really polarized. In the second scenario, where I'm reinvesting all of my dividends, I am yielding 92,753 per year, whereas in scenario 1, I'm yielding 59,292. So the two things here. After 10 years of investing in scenario 1, we know that my income increases 63%. That's by just experiencing the compounding of 5% dividend increases over time. By contrast, in scenario 2, I'm not only experiencing the 5% compounding of dividend increases over time, but I'm taking all my dividends and I am reinvesting them back into the stocks. By doing that, my dividend income over 10 years goes up by 155%. So 63 here, 155. So it's quite a discrepancy. And when I compare the two models, after 10 years of this investing, I'm actually getting 56% more income from scenario 2 than I am from scenario 1. And so one of the key takeaways here is if one has a lump sum to invest, if they need to retire tomorrow, it is possible. A lot of money is required, and thankfully there's some added benefit in there that the income will go up over time. So whereas things might be tight in year 1, it may be hard to make ends meet. After 10 years, one has a little more cushion because the income goes up over time. However, if one has a lump sum to invest and they don't need to retire tomorrow, they can delay it, maybe by 10 years. By doing that, the amount of income that one can receive in retirement is going to be substantially more. In this model, it's going to be 56% more by just waiting 10 years. And so that is what's so cool about reinvesting dividends. And what's funny here is both of these scenarios assume no more money is being thrown at this other than the original $1 million. But what gets really cool is, let's say in scenario 2, in addition to reinvesting dividends, I have a job still, I don't need the money for these 10 years, and I throw more money at it, I put more money into the market. That's a third lever that I don't even discuss here, because scenario 1, there's one kind of dimension. It's just the dividend increases over time. Scenario 2, there's two dimensions. It's the 5% dividend increase over time, coupled with the fact that I'm reinvesting dividends. Scenario 3, which I don't list here, is I'm literally putting more money. I'm taking more money out of my paycheck and investing it into dividend stocks each month. And scenario 3 is actually the scenario that I'm personally living right now. I don't need to retire yet, so I'm reinvesting all my dividends. I'm experiencing dividend increases, and I'm investing more money on a monthly basis. Scenario 3, you've got 3 dimensions of compounding happening here that really just accelerate this dividend income. So it's just so exciting to be a dividend investor because the math is on your side. The math works. The compounding is magical. It is amazing, and that's why I love dividend investing so incredibly much. And so I get a lot of questions here on my channel. Ian, you need too much money invested. It's just too much money to live off of dividends. And honestly, especially living here in the Bay Area, beautiful family, beautiful wife, 2 kids, it's quite expensive where we live. And so I would agree, if I needed to retire tomorrow and I needed to just put a big lump sum in the market and live off of a 3.64% yield, yeah, I would agree, too much to invest. However, the beauty of dividend investing is a lot of people, they're not in scenario 1. They fall in scenario 2 or even into scenario 3, like the one that I am personally experiencing right now, which is retirement's a bit in the future, and there's time. There's time for this cash flow to compound. And just this simple example here shows how quickly cash flow can compound. How quickly it can go from $36,000 a year to $92,000 a year without investing an additional penny. And quite frankly, by playing it pretty conservatively, a 3.64% starting yield, I am a conservative investor. I don't like to take big risks. Been there, done that enough times, and I found that just the simplistic strategy, the more conservative strategy, it works really well. It allows me to sleep at night. The kind of companies that I like to own are household brands like 3M. And so that's what's cool about this too, is it is all based on fundamentally sound companies, in my humble opinion. So technical video today, but an answer to a subscriber question that I have been receiving quite a bit, and so I am thrilled to do this. I know I'm throwing a lot of numbers at all of you, so what I'm going to do, again, in the description is I'm going to link to my email list. Sign up for the email list. Sign up as soon as possible, because in a few days here I'm going to take my Excel spreadsheet. I'm just going to mail it out to everyone who's on the list. And so you can be on any of my lists. I have a few lists. I have a list for my local Bay Area people because we do meetups. By the way, we just had the first ever PPC Ian meetup. It went so well, so incredibly well. Check out the picture. I'll show it right now from the meetup. I love you guys. You guys are the greatest. This meetup, by the way, totally exceeded my expectations. It was just so much fun. So we're going to do more of those. And thank you to everyone who made it. If you didn't, don't feel bad. We're going to have more of these. I'm going to organize more of these. So whether you're on my local Bay Area Crew email newsletter, whether you're on some of my other newsletters, email list, doesn't matter. If you're on one of my investing email lists from PPC Ian, you'll receive it in a few days. Anyways, check that out. Once you have the Excel spreadsheet in front of you, I think it will be easier to digest these numbers. You can play along at home. You can watch the video again. You can have the Excel spreadsheet in front of you. And feel free to move the numbers around. And so, again, there are a few numbers in the spreadsheet that are highlighted in yellow. The big ones are the 3.64. So maybe 3.64 is too low of an assumption. Maybe you think you can start with 4. Or maybe it's too high. Maybe you want to start with 2%. Whatever makes sense for your personal situation, you can throw around different starting yields in there. And then the growth rate, I put 5%, it's highlighted in yellow. If you want it to be higher, like 7, that is possible in my model. But again, the reason I keep it kind of low is because of inflation, and because in scenario 2, to keep the math simple, to make it easy to convey this principle on YouTube, I'm assuming that the stock prices are not going anywhere. And so the reinvested dividends, especially as we get out further into the timeline, they're buying just a lot of value, and they're driving a lot of incremental yield really quickly because the stock prices aren't going anywhere. So like year 1, after 1 year, my reinvested dividends, they're driving a 3.82%. But after a bunch of years, in year 5, I'm buying in at a 4.6. I'm buying in at really good yields. And realistically, that could happen, quite frankly, because we're starting to see the market show some volatility. I actually think there is going to be a correction, if not a crash, coming. I'll link in the description below. I think that, to a video I did about that, if it does come, I think what's going to fuel the volatility is going to be debt, just massive amounts of government and corporate debt. That being said, I like to invest monthly. I hope the market tapers off because I'll buy all the way down and then all the way back up. It actually allows me to achieve financial freedom quicker. And so scenario 2, quite frankly, could be possible. It could be possible that for the next 10 years, equity prices don't go anywhere. That being said, history tells me that they probably will trend up. And so again, that's a big assumption in my model that I want all of you to be aware of, but I counteract it by keeping my dividend growth a little bit lower than I otherwise would. I think at the end of the day, directionally, the point here is that scenario 2, by delaying financial freedom, it surely amplifies dividend income. Let me know what all of you think. I would be so curious. Are you kind of in scenario one? Are you like, hey, I got some money to invest and I'm going to invest it and live off of it tomorrow? Are you in scenario two where you're like, hey, I got some money to invest and to reinvest all the dividends. I'm going to retire sometime in the future, but I don't think I'm going to add much more. Or are you like me in scenario three, not portrayed here, where you're kind of, I'm going to retire in the future, I'm reinvesting all my dividends, but I'm also throwing even more money into my portfolio. I'd be so curious, which scenario are you in? What is your experience? I think we got people from all around the world here who are in all different types of scenarios. I would love to hear your opinion. So thank you for that subscriber question. Before we leave today, in terms of full disclosure, I own the stock mentioned today. I am long, I own shares of 3M, ticker symbol MMM. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for fun and entertainment. If you're going to go out and invest in the stock market, please consult a licensed financial advisor first. Literally just here on YouTube for fun and entertainment, sharing my personal dividend investing journey. Hey everyone, we're at 16,000 strong. If you enjoyed the video today, if you're a dividend investor, if you enjoy dividends, please subscribe. It means the world to me. And please leave a like, a comment. All of that is the best way that you can thank me for producing these videos on YouTube. And if you want to engage with me further, you want to see more insights on dividend investing, on life, I'll link in the description below. I am active on Instagram as well. Got some really cool content over there, so I invite you please to head on over to Instagram. Hey everyone, I will see you in the next dividend investing video.